Hello, today is August 2nd, Monday. Today's topic is how to understand underwriting. I've been using that term in a few videos and it's come to my attention people just don't understand what that term means. For those of us in the business, we kind of know it as second nature. Underwriting came from the term where somebody would write a risk. They'd write their name on top of a paper and what that risk would be. The person who would take on that risk would put their name at the bottom or under the risk. Therefore, you have underwriting. So, think about a bunch of kids in a schoolyard. You have a tall kid and a short kid, and you want to make a bet to see who can run across the parking lot the fastest. Most people would sit there and say, "Oh, I'm going to think the tall kid is going to win because with each step or each stride, they're covering more ground than the short kid." So you would sit there and say, maybe it's going to be an easier bet on the tall kid to run across the parking lot faster than the short kid. In a simple way, you've underwritten the risk of figuring out who is going to make it across the parking lot quicker. So think about getting a loan and your credit score. On my Discover card statement, they always publish my credit score. The higher the credit score, the happier I am. With a good credit score, with a good income, and good job history, you're more apt to get a better loan. A better loan can be a larger amount of money and or lower interest rates. That's underwriting. Underwriting from an insurance company's perspective is the insurance company is assessing the risk for a fee. It assesses the degree of risk, and the risk is how much they're going to have to pay for that fee. It establishes the premium, and it's using informed decisions in assessing the risk for a fee. So they're going to establish an appropriate premium at which they feel that they can make a reasonable profit against the loss potential for a risk. That is the insurance company's underwriting. So what information does the insurance company need? The focus is on the policyholder for the most part. They're going to look at demographic information. Demographic information typically can be your address, zip code, your age, your smoking status. That is for the most part demographic information. The other information that's important to an insurance company is pre-existing conditions. Are there any? What are those pre-existing conditions? Based upon that, what is the likelihood of future claims? That's important to an insurance company. Somebody who is older is more likely to have claims than somebody who is younger. Somebody who has a heart condition is more likely to have claims than somebody who doesn't have a heart condition. Before the Affordable Care Act, this is the way health insurance took a look at underwriting, assessing a risk, and assessing an appropriate premium. With the Affordable Care Act, they're no longer allowed to do that. Therefore, the insurance companies don't know the condition of the person that they're going to insure, and when that's the case, that just simply forces premiums up. So before the Affordable Care Act, the insurance companies used demographic information and pre-existing condition information. With the Affordable Care Act, they are no longer allowed to look at pre-existing condition, so that just forces premiums up. If you don't know the risk, you're more apt to charge a higher premium if you're going to take on a risk and a possible loss. In the past, with the pre-existing condition concerns for the insurance companies, they could issue the policy standard. They could say, oh, based on pre-existing conditions, we need to raise the premium. We need to issue a policy conditionally, and that might be somebody who has a build problem, height and weight. We're going to charge this premium, but if you get your weight down and you can maintain it for a year, we'll lower the premium. They could do a simple exclusion. We're going to issue a policy, but we're not going to cover this medical condition. Maybe you have a heart problem. We're not going to cover a heart problem. That was very common. Or they could flat out reject the policy. With the Affordable Care Act, underwriting for pre-existing conditions has gone away. This is one of the reasons why premiums under the Affordable Care Act have gone up and become so expensive. The insurance companies really don't know who they are insuring. If you look at life insurance, long-term care insurance, other types of insurance where pre-existing conditions are still used, premiums can be a lot lower or a lot higher based upon this. I hope this gives you a better idea and understanding of underwriting. People looking into health insurance and they would like to save money, please call me. Maybe we can save you money. I do have a couple of insurance companies that still underwrite, and those companies, especially in the group marketplace, are offering substantially lower premiums. If you're an individual on a Medicare supplement, you may want to consider a new policy if your premiums are high. Most plans are identical from one insurance company to the next. However, if you've been with a company for a while and that premium has gone up, you might consider changing to a new company. If you do so, most likely you will be medically underwritten. Blue Cross Blue Shield does not underwrite medically. Therefore, they typically have the highest premiums. They have the greatest following, to me it seems, but if you wanted to look at another company, say a AARP, Mutual of Omaha, Aetna, these companies medically underwrite, and therefore you could have the opportunity, if your health is good, to save substantial premium dollars. The number on the bottom of your screen, please give me a phone call. Be more than happy to assess your situation and see if we can save you premiums with a medically underwritten policy.